Good morning, good evening, everyone, depending upon the time zone you are logged in. We see that this session is attended from different countries and different time zone. So, welcome back to day 3 of our 9 days workshop on comprehensive HUF tax planning. These are the contents which we'll be covering in our 9 days comprehensive HUF tax planning workshop. In the last few sessions, we have covered introduction and legal framework of HUF. Today, we'll be covering sources of income, and over the next few days, we will dive into deductions and exemptions applicable to HUF, what are the taxation rates and rules across different structures, and we'll also discuss what are the tax planning and management strategies. We will also cover the partition of HUF implications, and we will review the real world case studies and wrap up with a comprehensive conclusion. So let's get started. Before we dive into today's content on legal framework of HUF, let's take a moment to recap the summary points from yesterday's session on introduction to HUF. This will help us to reinforce our understanding as we move forward with the day 2 of the workshop. A Hindu undivided family or HUF can be formed in 7 distinct ways, which we have discussed in detail in yesterday's day 1 workshop. It's important to note that ownership of property is not a prerequisite for the existing of an HUF. It means that even if you are a beneficiary of the property, that would be fine to be part of the HUF. Additionally, individuals with separate properties cannot simply pool their assets to create an HUF. However, if properties are to be thrown into the common pool, a designated HUF entity, even if it holds no assets initially, is essential. A co-parcener, which refers to a smaller family unit with joint ownership, is distinct from a full HUF. HUF can legally exist with just 2 members, one of whom must be a co-parcener. However, for the tax purpose, a minimum of 2 co-parcener is required unless the funds are received through the partition of the larger HUF. While it's not mandatory to have a legal deed to form a HUF, but it is highly advisable to maintain a written document outlining the key details such as property ownership and sources of income to ensure clarity and compliance. Day 2 workshop summary on HUF legal framework. In legal framework, recognition and residential status are the key drivers for taxation purpose. Let's first understand the recognition of HUF. HUF is treated as a separate legal entity distinct from its individual members, which means the status of the members and HUF can be different for taxation purpose. HUF must obtain a separate PAN card and is required to file its tax return independently of its members. Secondly, residential status of HUF. Residential status of HUF is determined by the location of its control and management of the HUF. An HUF is considered as residential HUF if its control and management are entirely within India. If the control and management are located partly or wholly outside India, the HUF is considered as non-residential. HUF residential status is based on the Karta of the HUF. Now that we have completed a quick recap of the previous day's workshop, let's take a break of 15 seconds before we dive into today's day 3 workshop. Thank you. Welcome back after the break. Now we will discuss about different sources of HUF income. HUF income can be from income from property, income from business, income from other sources. Let's understand that how the income will flow into these different sources. Firstly, income from property. The HUF may generate income from ancestral property through rent or lease agreements. Another source of income can be sale of immovable property owned by the family, such as land or building passed down through the generations. Second, income from business. If the family owns a business, profit generated from this family owned business contributes to the HUF income. Additionally, any professional services provided by the members of the HUF, such as consulting or legal work, also fall under this category. Lastly, Income from other sources. The income can also be earned from investments such as dividends, interest, and capital gain from shares or other financial instrument. Lastly, if the HUF owns agricultural land, any agriculture income from farming activities is considered a part of the family's income. Now, since we understood the different sources, let's jump in and understand how the income tax slabs are structured for HUF. Let's move to the next slide, please. Thanks. Now let's discuss about the income tax slab. The HUF is subject to income tax under the same tax slab as applicable to the individual taxpayers. This means that income earned by the HUF is taxed based on the progressive tax rate, which call as a slab basis set by the government for an individual, ensuring that more the income, higher the tax liability. Just like individual, the HUF can also benefit from deductions and exemptions available in the Income Tax Act, such as Section 80C, helping them to reduce the overall tax burden. As you can see on the screen, the income tax slab rates for HUF follow the same structure as for individual taxpayers based on the income earned. Let's break this down. Here we have shown slabs under both new and old tax regime. Let's understand under new tax regime first. If you see that up to 3 lakhs income, no tax. If 3 lakhs to 6 lakhs income, it is 5%. And if it's 6 lakhs to 9 lakhs total income, it is 10%. And if it is 9 lakhs to 12 lakhs, it is 15%. If it is 12 to 15 lakhs, 20%. If it is greater than 15 lakhs, it is 30%. Now let's look into the old tax regime. Up to 2.5 lakhs, no tax. 2.5 to 5 lakhs, it is 5%. And greater than 5 lakhs to 10 lakhs, it is 20%. And if it is greater than 10 lakhs, it is 30%. In the old tax regime, it is simply the 4 slabs from the long time, whereas in the new tax regime, there are different slabs are there, really 6 slabs are there, reducing the tax liability on that. So what we do here is that we compute the tax liability both under the new and the old regime, and whichever is more optimal for the taxpayer, that would be selected on that. Apart from the income tax, HUF has to pay additional surcharges and cess. 4% health and education cess are applicable across all income levels, whereas surcharge is applicable if the total income crosses 50 lakhs. Surcharge is also as a slab starting from 10% on the lower side and 37% on the higher side, depending upon the income level. As we conclude day 3 of our comprehensive HUF tax planning workshop, we thank each one of you for your participation and engagement. We hope today's session on the different sources of HUF provided valuable insights into structuring and managing your HUF effectively. We hope our team has answered all the questions raised in the chat box. And still, if you have any further questions or need personal guidance, feel free to reach out to us. You can contact us at our mobile number or visit our website or send an email displaying on your screen. We look forward to seeing you tomorrow for the day 4 workshop, where we will explore deductions and exemptions applicable to HUF. Thank you.